So still on the Bank of Indonesia regulations. So BI recently just announced a decision to expand the range of subsectors of priority sectors that receive macroprudential liquidity incentive. I need to hear your opinion on it. In general, how does it give a good incentive to the economy and to sectors that are being pushed currently? And to what extent can this policy influence the mapping of prospective credit sectors for DBS?
Thanks. So I think first and foremost, we really welcome this move by Bank Indonesia. What we also notice is that, given this recent relaxation on subsectors under the priority sector by Bank Indonesia, for the macroprudential liquidity incentives, we expect that additional liquidity incentives are going to be close to about 81 trillion IDR. That will take the total liquidity incentive to about 246 trillion IDRs, and that's quite a substantial amount. As far as DBS is concerned, in Indonesia, we are completely committed towards nation building. So as a bank, we have been supporting a lot of priority sectors for the last many years. And going forward as well, with this expansion, our plan is that, we will continue to expand our coverage in the priority sector, space. So it's a great move, and I think from our perspective, I think it's more of believing in doing good and doing well. So that's one thing which DBS believes in. So I think this is something which will just help us contribute more towards the society.
Okay. Well, thank you so much for the commitment from DBS Indonesia. So domestically, the elections, the February has been finished. So the political stability is not to question anymore. The Eid, the Ramadan has passed.
Right.
The Q1 2024, we have faced a lot of dynamics. Any performance evaluation for DBS Indonesia for the first quarter of 2024, in your thoughts?
Yeah, I think the conclusion of elections, I think a lot of uncertainties are now behind us. Uncertainties around political stability, as I said earlier, or or even as far as steady regulations are concerned. So that's a very good thing. The other thing is that even when we speak to business houses, in the country, generally we see, we hear a lot of optimism around the economy, and I think we should see credit growth picking up, as the year progresses. If you see at the moment, we are seeing largely the credit growth happen in the metal and mining space. So that space is quite promising, and we're seeing a lot of downstreaming. Even in the soft commodity space. Another promising sector for us is the EV value chain, including batteries.
Okay.
So that's where DBS is quite active. We have our industry experts, who continuously guide and look for opportunities to help corporations over here. Other than that, another interesting area which is close to our heart is the transition financing. So we do see in that space, a lot of activity and credit demand. And last but not the least, green financing.
Okay.
So these are the broad sectors, where we see, and DBS will continue to focus to extend credit. And as I said earlier, we also want to leverage our regional coverage. So plan that, we see a lot of multinationals who want to enter in, especially Asian multinationals who want to enter Indonesia. So help them navigate, help them with banking solutions onshore. So I think overall, from that point of view, I think we think we're in a good place, and I think we'll be able to kind of see decent credit growth.
Now that you mentioned about the downstream policy, the priority regulations in the current government, which is Joko Widodo's government, is a downstream policy in some of the mining industry, metal industry, and so on. How do you think this regulation, this priority regulation, will also affect the credit growth for banking, especially in DBS? Has it been impacted to your credit growth for this?
Oh, definitely. It is contributing towards credit growth, because we do see interest from whether it's smelters for value addition that has to be done. So it's clearly, I think, the policies of the government are definitely, getting implemented, not just by DBS, but most of, we're seeing the entire bank, all the banks there to kind of support this initiative, which eventually helps the country. So definitely this will be it's just going to be another credit growth engine. For the country.
Okay, so your thoughts on that. Thank you so much for that. And we need to hear also your opinion about the monetary policy globally. Just last night at the FOMC, Jerome Powell and its team also have been announced that the inflation is still stubborn, and there will be no rate cut just around the corner. Probably there will be no landing scenario that has been expected by the market since 2023. So it's almost always shifting. If at the 1st January we thought the rate cut will be around March or April or May, and then on March we thought that the rate cut will be on June, now that we're reaching May, probably there will be no rate cut for the whole year. So what's your thought on that, and how do you think this eras of high interest rate will also affect the global market and financial market globally?
Great question. I think, again, as we just heard Jerome Powell's speech from last evening, I think clearly the US inflation is very stubborn. If we look at the US core PCE and CPI numbers, they have been on the higher side compared to what the market's been expecting. And clearly it looks like the 2% target which Fed has is going to be extremely challenging, and it's not going to happen anytime soon. On top of it, obviously we're seeing the job market also being pretty hot. The unemployment rates are pretty low at the moment. So all in all, because of that, it's pretty clear that the Fed rate cut decisions are going to get delayed, and obviously the amount of rate cuts that the market's expecting are also going to decrease. Clearly, the Fed fund futures is showing it at the moment. The expectation this year is now about 35 basis points. Tomorrow we've got the non-farm payrolls, which is coming out.
We're going to see about
exactly.
the data.
Another strong print, and we could probably see only one rate cut probably this year, and of 25 basis points. So I think the decision is going to be very data dependent from Fed. In general, the market was actually expecting that high nominal interest rates and high real interest rates are eventually going to derail the economy. This is generally because the rates have been high for pretty long time. So this was the expectation that the market had, but the market has been proven wrong. Clearly, the data coming out of the US is pretty robust, pretty resilient. What we are also noticing is that in the corporate debt and the consumer debt, surprisingly, has been locked in at pretty low rates during the pandemic era. So that's kind of shielding them. So that's one. The other thing is that with these, with the rate hikes over the last couple of years, we have not seen the kind of bond market volatility that used to happen in the past, because the private sector is now investing a lot in US treasuries. So that's another interesting phenomenon.
Okay.
And the third
thing, is a good thing?
Which clearly shows that they have got excess cash. So obviously the balance sheets are much more robust, and obviously and the rates are good, so they're investing into risk-free. And the third thing is that barring a few regional banks, which other than that, if you look at the banking sector in the US, again, is pretty resilient. They have been able to absorb these rate hikes quite well. So it's quite clear that I think the US economy at the moment looks quite sturdy, and the rate hikes have not had the kind of impact that the market was expecting.
It's a 5% rate hike, right?
Yeah,
from around 0% to 5.25 until 5.5%, and I thought the macroeconomic will absorb all of this impact, but then again, the PC is still robust, the non-farm payroll is still high, and the inflation is still around 3%.
Absolutely.
Wow. Okay. No. Assessing all this situation and the sentiments, both in the global or domestic, do you have any evaluations or your thoughts about the resiliency of banking industry in Indonesia overall, Puneet?
So just on your previous question also, I wanted to highlight that, yes, the risk is obviously in which we are seeing the outflows of dollars, so that's the other thing, and that's why, central banks are being very, being extremely proactive. Now, moving on to, Indonesia, I think our banking sector is I think, in quite a solid state. If you see, for the rest of the year, given elections are behind us, we're expecting a 5% growth. BI and OJK are projecting 10 to 12% credit growth. I think, and if also look at how the first quarter has been, the first quarter credit growth has been pretty robust. As I said, it's about over 12%, which is actually on the higher side of both BI and OJK's projections. I think the banking sector looks quite okay. Interestingly, Feb was also an election month, but still we saw good credit growth in Q1. The corporate demand for credit is also pretty robust. If you look at the top 4 banks, we are seeing actually between 14% to 22% growth on the corporate credit side. So I think that side looks pretty good. I think credit growth looks pretty good. The one thing that we have to probably watch out for is liquidity.
Okay. I just want to ask you about it, the liquidity.
So one is obviously, is because, when the loan growths are happening at about 12+%,
yes,
and deposit growth only around 7%.
That's true.
So we're clearly seeing that, the LDR for banks or the banking sector has spiked to about 84% compared to 80% last year, early last year.
What is the healthy level of the LDR?
I think it is in a healthy state. I think it's just that we have to watch out for.
Okay.
There just are some banks. Just be cautious. But I think it's in a comfortable band at the moment. Only thing is that there are some banks where the LDRs are on the higher side. So all the way up to 95%. So that's one thing to kind of to watch out for. Okay. But at the same time, if you compare to pre-pandemic era, which is basically if you look at the December 19 numbers of LDR, I think LDR used to be 94%.
Yeah.
So we are in a comfortable place. But yes, the way it's, the LDRs are rising, the loan growth is increasing and the deposit not at the space, I think this is the space where we have to be just more vigilant, watchful. Other than that, I think the rate hikes that have happened, that has happened recently by BI, it definitely is going to push up the cost of funds for banks and for the industry. But again, as I said, it's only 25 basis points. So it's not substantial. It's not substantial. It's more preemptive and just to kind of, handle the situation at the moment. But what I see is that I think overall, the commercial books of banks are going to look good because, the loans are going to get repriced. Okay. The trading books are the ones which are going to take a hit. Because the valuations of bonds are going down. So that's the thing. But on an overall basis, I think the banking sector should be okay with this rate hike. The good thing is that I think if you look at the asset quality is pretty decent. The NPL ratios have been coming off the trend, and if you see at the moment, I think it's sub 3%. We also see that the NPL coverage ratio is more than sufficient. So overall, I feel that I think the banking sector is in a good position.
So and optimistic, but still be cautious, cautiously optimistic about it.
I mean, I won't be that cautious, but I will be vigilant. Yes,
vigilantly optimistic. Yes. Seeing the numbers of the banking industry. Well, wonderful. Thank you so much, Puneet, for valuable insights for the CNBC Indonesia viewers, especially in banking industry in Indonesia. And how about the resiliency of macroeconomic conditions in Indonesia? Thank you so much for that.
Thank you once again.
And I wish you all the best success for DBS and for Puneet as well. Thank you so much. Sir.